Welcome to the webinar this evening hosted by H&R Block in partnership with Airbnb. We are here this evening to provide information to the Airbnb host and hostesses across Canada in preparation for filing your 2019 income tax returns. Little background about H&R Block. We are one of the largest retail tax preparation firms in Canada, and we've been preparing taxes for Canadian residents for over 55 years. We have 1,100 offices located across the country, which means there's one in your community, and we have over 7,000 trained tax professionals ready to assist you. Our tax professionals, including myself, receive over 60 hours of training in preparation for the tax season so that we are current and up to date with the tax law changes. And that's what we are here to share with you through this webinar this evening. Welcome again. My name is Lisa Gittens, and I am a senior tax professional with H&R Block. I will be your moderator this evening. For Airbnb hostesses, if 2019 is the very first year that you are coming into this role, what we want to let you know is that at H&R Block, we are offering special flat rate pricing for our hosts, and anyone who's coming into the retail office between that January 1st and right up until March 31st, we have an early bird price of $149.99 to prepare your income tax return. That's a savings to you of $165. If you're ready to file between April 1st and April 14th, we offer our mid-season pricing, which is a flat rate of $199.99 per tax return. Again, that's a savings to you of $115. And if you are filing April 14th or after, that is our busiest time, and our prices at that time are $249.99 flat rate to prepare the income tax return for you. It still offers a savings of $65 per return. We want to remind you that these are exceptional savings. We're giving you the pricing upfront so that we can focus on serving you and taking the stress out of your tax season. Now that you know what to expect with the costs, this evening we want to discuss with you how you're going to be reporting the income that you've earned as a host or hostess, what you can and cannot claim, what are current versus capital expenses, keeping your records, what to keep, how to keep them. We're going to give you some information about GST registration. We're also going to discuss income tax payments and how you will know if that applies to you. We want to discuss what to do if you are audited by Canada Revenue after filing your return. And we're going to invite you throughout the presentation to write your questions in online. We're going to have a live question and answer period at the end of the presentation. But throughout, as I'm sharing the information, please submit your questions. So it's 2019, and you are stepping up to be an Airbnb host or hostess. Whether this is your first time or whether you've been doing it for a while, what we want to remind you is that when you are doing short-term rentals, unless you're providing extra services such as meals or laundry, your income is considered rental income and not business income. It is included with all of your other income on your T1 tax return. So if you have employment income and you're receiving a T4, if you're receiving investment income with your T5 slips, or pension income, even such as the Canada Pension and Old Age Security, when you file that individual tax return, you are going to add to that return the income earned as an Airbnb hostess. And to do that, you're using Form T776, which is the Statement of Real Estate Rentals, and that is a specific form used to calculate the income less the expenses and report the net rental income as your taxable income. And a tax professional like myself with H&R Block will be happy to prepare this form for you. Again, you can have an H&R Block tax professional prepare your return in a retail office. We are available through Online Tax Expert, where you can upload your documents, and again, we'll prepare the return for you. Or you can prepare the return online using our do-it-yourself software. You know the costs, you know where you can go. Now let's talk about what some of the expenses you may incur as an Airbnb host. So typical expenses would be your yearly household expenses. And these expenses must be prorated to determine business use if you are renting out a part of the home where you normally reside. Expenses such as utilities, insurance, property taxes, and the mortgage interest. These are the most common expenses incurred. When we talk about prorating, we're looking at the amount of time that you are renting out that unit, as well as the square footage of the home. So if you live in your home, but you are renting out a room, or you're renting out the basement, we look at the square footage of the rental area divided by the square footage of the total home. That gives you a percent that you can claim of the utilities, the insurance, property tax, and mortgage interest paid for the entire home. Now, if you are only renting out during a specific season, summer, spring, winter, fall, or only renting out for a few days in the year, then we reduce the percentage of the square foot further by the number of days. So if it's 14 days out of 365 that you've been renting out that house, we're going to divide the 14 by 365 and we'll get a second percentage. These percentages are used for prorating your expenses. Please don't think it's complicated. These are all calculations that are completed on the T776. And if this is your first year stepping in as a host, this is where your tax professional is there to help you. If this is not your first year and you're a pro at it, then you already understand the percentages I'm discussing. Make sure you keep up with that on your 2019 tax return. Keep in mind that the proration only comes into play if there's a personal use part of the home. If you're renting out a part, be a room or the basement. If the entire home is available to generate income, then you're claiming all of your expenses in full, including the costs of cleaning that home before the guests arrive, and whether it's personal or fully income-based, the cleaning supplies that you're using to prepare that home for the guests. A recommendation here is if you're going to the grocery store, Costco, your neighborhood store, keep a separate receipt for the cleaning supplies that you're using for the rental part of the home. That way you will be able to clearly claim the full cost of the supply as well as any taxes on that receipt, rather than having to scroll through your receipt to say, what part of the bleach did I use? Keep that separate receipt. For cleaning supplies, your soap and bathroom supplies, including those complimentary gifts that make your experience unique, like bottled water, chocolates, flowers in the room, even those baked goods that may meet your clients when they arrive. You also want to be clearly keeping receipts for any damage that may be caused by a careless guest or by an accident when they're moving in or out. Those receipts you want to have clearly noted, the date, the place that you purchased the item with, or the contractor who came in to do the repair, and any tax that they may have charged you. A little bit more with the type of things that you're able to deduct on your tax return. Tax preparation fees. And we discussed our upfront pricing. But what you need to know is if you are paying a bookkeeper to keep track of these receipts, to track your income, then those costs are also deductible on the tax return. Please keep in mind, the costs that you paid in 2019, that's what you deduct on your 2019 tax return. So make sure you're keeping the receipts. The full cost of the bookkeeping and the full cost of the tax preparation is deductible to you as an expense. All of what we've discussed so far would fall under current expenses, and we want to make sure that you understand the difference between capital and current expenses. So a little bit about capital. Capital expenses or properties would be assets such as a building, household appliance, or furniture. Any repairs done to your property, if you're having to replace the glass in the window because it was broken, that's a current expense because you're replacing the glass, or if you're replacing that window with a window of the same quality because it was damaged, that's a current expense. That's something that was used up in the year. Capital expense is where you make an improvement to the property. So in preparation to rent out your property, if you replace the windows for something that was more energy efficient or to upgrade it, that now becomes a capital cost. You've replaced that window with something that has a superior value, whether it's a window or a door. When you replace that, it becomes a capital expense, and therefore you're going to claim a portion of that expense in the current year, and you're going to claim a portion of that expense over a period of years until it is used up. Current expenses are claimed in the year that you incur them, and they are deductible 100% on the tax return. Capital expenses, as I said, are not claimed all at once, and they are noted on the T776 rental income form under the section called Capital Cost Allowance. Now, for properties that were purchased, if you purchased this home to be an income-producing home, in 2019, the federal government introduced the Accelerated Investment Incentive. And that meant that for these capital expenses, you could now claim up to 150% of the depreciation in the first year. If you acquired the property, the appliance, the furniture after November 20th of 2018, and you are using that property or asset before the year 2024, you are eligible to claim the Accelerated Investment Incentive. We are focusing this evening on not just new hosts and hostesses, but those who've been in the business for previous years. And so for 2019, this is something you want to pay particular attention to. We do have a slide which helps you to understand how this capital cost will affect you and how this expense can reduce the income that you're going to pay tax on. So let's take a figure of about $10,000. You took that $10,000 and you invested it, perhaps in furniture and appliances for your rental unit. So when you look at the graph, you see you started out with a $10,000 capital expense. Because this is furniture and appliances that we're discussing, they're going to fall into a capital cost class, which is Class 8. And Class 8 carries a depreciation percentage of 20%. That's the regular rate. To apply the accelerated investment incentive means that in the first year, you are now claiming 150% of the regular rate. So you're looking at that $10,000 multiplied by 30% for the first year rather than the typical 20%. That 30% means in the first year, your capital cost expense is $3,000 deducted on your income tax return. The T77 is the form where you're tracking this. There's a specific section that you're filling out for the calculation. In the second year, your asset was at $10,000, you expense $3,000, you start off with a $7,000 value for that asset, and of the $7,000, now you are going to claim 20% as the depreciation expense, which gives you the figure of $1,400, because the second year has dropped down to 20%. It is only the first year that you get the accelerated investment incentive. And for every year that you are claiming the capital cost, you want to keep track of that T77 form, and you will see that the expense is used up over a period of about 5 years for a Class 8 asset. So it's very important in keeping your records. You have your receipts for income and expenses, and you're keeping the T776, which is part of the income tax return that you filed. Still with capital cost, we want to make sure that you understand we are speaking about things like appliances or furniture that are used in the area that you are renting out. So if those appliances and furniture, that $10,000 investment was specifically for that rental area, you are claiming the full capital cost allowance on that $10,000. If the appliance or furniture that you purchased is in an area that is used partly by you and partly by your Airbnb guests, then you are claiming a prorated portion of the capital cost. And to calculate that proration, we go back to looking at the square footage of the space and the number of days that you rented out that space. I want to mention here that although you are allowed to claim capital costs on the building that you purchase, there are two things that we want you to consider. We don't recommend the capital costs if that building is a building where you are living in it and you want to be able to claim the principal residence exemption when you sell. Claiming capital cost on that property makes you exempt from claiming principal residence exemption should you sell in the future. The second thing to keep in mind is if that building sells for more than the original cost, plus the capital improvements you've made, capital cost allowance is recaptured in the year of the sale. Simply put, it means that when you sell that home, the capital cost expenses that you've claimed in the previous years are added back to your return as income. And it is for this reason that although you're allowed to claim, your H&R Block professional is going to recommend that you don't do so. You may have a unique situation, and this is where you need to talk to your professional. So we've looked at the income, we've looked at the expenses. Let's now discuss what types of records you need to keep. It's always important to keep good, clear records of your income and expenses. So the date that your guests checked in, the date that your guests checked out, what was the amount that they paid you, and if there was any tax on that original charge. When it comes to the expenses, your receipts must include the vendor where you purchased the item, a description of the item that was purchased, the cost of the item, and if there was any tax that you paid. Again, if you're buying paint at the hardware store, you need more than the credit card slip to satisfy Revenue Canada's document requirements. And we recommend if you're going to paint the house, you have a separate receipt for the paint that you're going to use in the rental area. That will keep your books clean and simple. Speaking about records, in addition to filing your income tax return, you may also want to register for GST purposes. Now, long-term residential rentals are not subject to GST. You do not need to register, you're not recharging it, you're not reporting it. However, with Airbnb, you're typically doing a short-term rental, which means it's less than a month, less than 30 days. And these rentals are subject to GST if the rent that you're charging is more than $20 per day. If your fee exceeds $20, you need to be charging GST to your client. However, you're going to register for GST specifically in that period where you're done your 2019. If you've earned more than $30,000 in those 4 quarters of the year, or in any quarter where you earned $30,000. So for January to March, if at the last week in March you've earned $30,000, the minute you hit that $30,000 mark, the next client that comes in, you're required to charge GST. You have 30 days to register with GST and receive your number. Revenue Canada will send you a package which gives you the forms that you need to fill out. It tells you how to report and when to report. Remember, you're only needing to register for GST if you are charging more than $20 in the day, if you've earned more than $30,000 in any single quarter of the tax year, or if you have earned $30,000 in the 4 quarters together, so at the end of the year. And once you register for GST, it's not just about collecting it from the client, but all of those receipts that you've been keeping, the GST on the receipts, you are now able to claim as input tax credits on the GST 370 form. It's filed separate from your income tax return. little bit more about GST and how it impacts you as an Airbnb host, if your home is used only for personal use or for long-term residential rentals, you do not charge GST when you sell the home. However, if you're using your home more than 90% for short-term rentals, when you sell that home, you are required to charge GST on the sale. If you convert your home from personal use or used it as a long-term rental and convert it to a short-term rental, again, you'll have to pay GST on the value of the home at the time of conversion. So you're changing the use of the home. If it's going from personal or long-term to short-term, you'll have to pay the GST on the value of the home and the date that you changed the use. If that situation applies to you, again, it is something you should discuss with your tax professional. Now, we've looked at your income, we've looked at your expenses, and we've looked at your GST reporting requirements. We want to spend a moment and look at occupancy tax collection agreements. Airbnb has entered into these agreements with provinces like BC and Quebec. There are a number of municipalities in Ontario like Ottawa, Mississauga, Sudbury, Barrie, Windsor, Waterloo, and Brockville. These are taxes that Airbnb adds to the reservation fee. So this part of the tax is collected and paid directly to the provincial governments by Airbnb. There is no additional paperwork for you as the provider, host, or hostess. Small relief from the paperwork. Now let's talk about installment payments. Installment payments happen because you are earning this income directly. There is no tax, no income tax federally or provincially that's being withheld. And when you file your income tax return, this additional income is added, as I mentioned previously, to your employment income, pension, or investment. And you are now going to be taxed federally and provincially, which may result in you having a balance owing at the end of the year. If this balance owing is $3,000 or more in the 2019 tax year and in the 2 preceding years, then what will happen is come August of this year, after you filed your 2019 tax return, you are going to receive a notice from Revenue Canada that tells you the amount of installments they want you to pay. And that first installment payment is going to be due on September 15th. There will be an additional payment on December 15th. What you are doing is prepaying for your 2020 taxes. You'll make 2 more payments in the year of 2021, in March and in June, so that when you file your 2020 taxes, you have prepaid those installment payments, and then you won't have to pay any additional tax when you file. Let's step back a bit for the 2019 tax return. If this is the first year that you're stepping in as a host and your balance is $3,000, you are not subject to these installment payments unless you have owed $3,000 or more on your previous 2 tax returns. For 2019, if you paid installment payments, those installment payments are credited by reporting them on your tax return so that when you file the tax, you have already paid the amount that you owed. And now that you know you've filed and you've paid your balance, what are the next steps for you? Let's talk a little bit about Canada Revenue's audits or assessments. Even a return that is 100% accurate can be reviewed by Revenue Canada. Now keep in mind, most audits are no longer conducted in person, but you simply submit the information requested by mail. Today, with all of the technology we have, you can also submit your documents online through My Account, which is a secure portal on the Canada Revenue website. As long as you have the paperwork to back up your claims, you have nothing to worry about. And that's the purpose for us doing this webinar this evening, is so that you understand clearly what are your reporting requirements for the income and the paperwork needed to back up your expenses. When you file that tax return, Revenue Canada sends out an assessment notice. That assessment notice tells you, we've received your return, here are the numbers that you submitted. That assessment notice is a legal document, so keep it safe. As we progress through the year, April 30th is your tax deadline to file. June 15th is your deadline if you have the self-employment income. Revenue Canada keeps working. So they pull up your return and they send you a request for documents to show the utilities that you claimed or the insurance that you claimed. As long as you submit that document by mail or online through My Account within 30 days of receiving the request, no further action is required. If, however, you don't have the paperwork, that's where H&R Block can step in. We can help you to look at what documents you did have when you originally prepared the return, guide you to know what format you're submitting those documents into Revenue Canada, or even assist you with submitting the documents to Revenue Canada. But you must do that within the 30-day deadline. If for some reason you've missed that deadline, again, H&R Block can step in with you to contact them to arrange an extension, explaining the circumstance. If you are reassessed even after submitting those documents and you disagree with the decision, you can further appeal by filing a notice of objection. And at every step of the way, with the audit, with the appeal, or the notice of objection, H&R Block tax professionals are there to help you with Revenue Canada, to put the documents in place and to submit them directly. And how do we offer that service to you? When you walk into the retail office, we've told you about our flat rate pricing. In addition to that, you can purchase what's called peace of mind. Now, everyone coming into the retail office is guaranteed a maximum refund guaranteed. We minimize your balance owing as low as we can make it, and we have provided an honest and accurate return for you. But in case you are audited, the Peace of Mind program is an extended service plan, which means that our tax professionals are there to assist you, whether it's Canada Revenue or Revenue Quebec, the audit, the assessment process, and we cover you for 3 years after filing that tax return. We're there to give you the audit representation, the year-round support, and if there was an error that we made in preparing that tax return, we will pay, H&R Block will pay up to $3,000 of additional taxes if it is found as a result of an error we made. Regardless, we are there to help you from the beginning to the end, preparing the return, submitting it to Revenue Canada, and following up with your audit or assessment. I want to thank you for your time, for listening to me so patiently, and now we'd like to open it up to hear from you. So we'll take some questions. First question coming in. Perfect. I didn't keep all receipts. Is there any way to claim without them? Now that's a very good question, because one of the things we find is even if you've kept all of the receipts, at times those receipts can fade away and be a little difficult to read. We don't want to go back to what our grandparents did and put everything in a shoebox, but you've got a smartphone. So take the photograph of the receipt so that you have it with you. And by all means, do not enter a claim into your return unless you have the receipt to back up the amount. If you found, here's another question, if I found an old receipt from last year, can I claim them this year? So if you have receipts from 2018 that you didn't claim on that return, you cannot apply those expenses to your 2019 taxes. What you can do is you can file an adjustment to include the 2018 receipts to your 2018 tax return. You can do that online through My Account, simply uploading the receipts to Revenue Canada or coming into our office, and a tax professional will be happy to file that adjustment for you. Perfect question. Now, does Airbnb report my earnings to Revenue Canada? Very good question, because we see that there's a lot of income being generated with websites. We have this gig economy that you are now a part of as a host. And Revenue Canada, Airbnb is not responsible for submitting any income information to Revenue Canada. Based on our self-assessment system, you are required to report your income earned from self-employment on your tax return. This is why it's so important that you are keeping accurate records of the income earned as a hostess. You report it to Revenue Canada, not Airbnb. Keep your questions coming. Can I pay myself as a housekeeper to clean my property and claim that expense? Love this question. Unfortunately, the answer is no. Any time and labor that you invest into earning this company is not a deductible expense. The supplies that you purchase are definitely an expense, and remember to keep that on a separate receipt. But the time that you are investing, no. If you pay someone to come in and do the cleaning, then you're getting a receipt from them, and that is deductible as an expense. Going back to the bookkeeping, if you're the one sitting in the office and putting all of the paperwork together to get ready for filing, your time for bookkeeping is not an expense, but if you pay someone to do that on your behalf, then that bookkeeping receipt is claimed as an expense on your tax return. Great question. Are guest gifts of alcohol deductible or only non-alcoholic gifts? Now, if your guests are coming in, and we discussed you're making things like flowers or croissants, things available for them to use, keep a separate receipt. that alcoholic beverage that you provide in the home is deductible, but what you may have to look into is what are the provincial requirements allowing you to serve alcohol to the guests in the home. That I can't cover on the tax return, but I can tell you if you purchase that solely for the use of the guests, keep a separate receipt and it is deductible. Next question, is it considered rental income if your property is owned by a corporation? Now that's an interesting question, but I'm not aware of the corporations that are doing this as an Airbnb host. And for our purposes this evening, we're speaking more about your individual tax return and you as an individual host filing your income earned as well as your rental income on the T776. Corporations have different forms. That's a whole different ball game outside of what we're covering in the webinar this evening. Please talk to your tax professional. Can a husband and wife split the income of a property rental? Beautiful question, and yes. You can split that income 50-50, 60-40, 70-30, however you see fit. Generally, if you're both working, you want the one with the higher income to claim the smaller share. Just be sure that the property is a joint owned property. Both of your names are listed on the property, and then you can decide the split. When you fill out the T776, it will actually ask you if you own that property as a sole owner, as a joint owner, and what part of this income is attributed to your return. Also on the T776, you're going to list the name of the individual who is the co-owner, and you're going to allocate to them their percentage. Perfect question going back to the proration. Is it prorated for the number of days you make it available or the number of days it's rented out? Beautiful question. And so what you want to look at there is the number of days that you have it available, because you may have your property available for 30 days, which means it's listed as available for 30 days. Your tenant is there for 14 days. But the utilities paid for that 30 days, that is based on the proration of the 30 days that you had it available on the market for rental. Beautiful question. If you claim mortgage interest of your principal residence, is the future sale of your home subject to capital gains tax? Good question. Remember when we were discussing the expenses, we said that you, if you're living in that home or renting it out fully, you can claim the mortgage interest as an expense. What comes in for capital gains is if you are claiming depreciation, capital cost allowance on the home itself. If you are claiming capital cost on the home, when you sell the home, the capital cost expense over the years that you claimed it is added back on your return in the year of the sale as income. And I hope I've made that clear. I had repairs in my house in 2019. Is that deductible? So this is 2 parts to this question. We're going to take it in 2 parts. The repairs that you did, if you live in that home and the repairs were done to the area specifically that's rented out. So if it was a window repaired in the basement, that window, if it's repaired, it's a current expense against the rental income for that space. If you replaced the window, it's a capital expense incurred against the income in that space. If you repaired the roof, that's a repair that's done to the entire property, and that repair is going to be prorated based on the square footage of where you live versus the square footage of what is rented out. It is deductible, but if it's a shared repair, it must be prorated. The second part of that question is, if furniture was damaged and new furniture purchased, can you claim it all at once or across the years? So, very good question. In the presentation, when we were discussing capital cost, we had a figure of about $10,000 used to purchase furniture or appliances. If that furniture is costing you more than $500, it is sitting as a Class 8 asset, and it is depreciated over the time that you have the furniture. So as a capital expense, only a percentage of the cost is deducted year over year, not the full cost of the furniture deducted in the year that you purchased it. How do we calculate the deductible amount in shared spaces, i.e. the kitchen or the living room? Beautiful question. So again, the kitchen and living room, bathroom, bedroom. These would be 4 rooms that are shared space. What is the square footage of those 4 rooms divided by the overall square footage of the home? That will give you the percentage to prorate your expenses such as mortgage interest, utilities, and insurance. Very good question. Next, is energy efficient appliance upgrades a capital or current expense? So we've got 2 parts to this question, and you're purchasing an energy efficient appliance. So that means you are replacing what exists for something of a better value. That is a capital expense, and therefore you're going to claim only the depreciation expense over the years that you own that appliance. Again, if you purchase that appliance, you spent $2,000, it is a capital expense. The $2,000 is not deductible in full on the 2019 return, but 20% of that appliance is deductible. If you purchase that appliance after November 20th, 2018, in the first year, you can deduct 30% based on the accelerated investment incentive. And what about landscaping? So if you're doing the landscaping outside, that's a brilliant question. We have summertime, you've got to cut the grass. Fall, you've got to rake the leaves. Wintertime, you're shoveling snow and putting the ice on the sidewalk. Those are deductible expenses prorated against the square footage of the home, the total square footage, divided by the area that you are renting out, and further reduced if you are only renting it out for a few days in the month. Again, if this is the first year for you as a host, this is a calculation that is done on the T776 form, and your tax professional is there to guide you through so that you have the correct percentages to use for 2019 and future years. Terrific questions. Keep them coming. Is Airbnb's fees deductible? Now, when we talk about the fees, are we looking at what you are paying to be enrolled as an Airbnb host? Are you looking at the service fees that are being charged to you as a host? Then yes, they are deductible because you are incurring those fees specifically to earn income. So those fees are fully deductible on your T776 against the rental income earned in the year. Can you claim the legal fees you paid to buy the house? Good question. Legal fees that you pay to purchase the house are not going to be deductible on the tax return in the year that you purchase the home. Those will come into play when you sell the home. It really is a personal expense. If you purchase that home as a rental property, again, they will not come into play until you sell the home and we are calculating what is the profit or loss on the sale of that home. I have a GST number, so we're switching over to the GST registrations. I have a GST number from another business. Can I use that for Airbnb? And the answer there is yes. When you register for GST, you register as an individual with your name, unless you have a business, a small company that has been registered. And that registration number is used to report all of the income that you've earned in the year or in the quarter across 1, 2, multiple businesses. As well, the GST that you've paid, those input tax credits, are claimed across all of the businesses that you operate under that one number for the quarter or for the calendar year. Next question. I am a host, but also rent this property from someone else. What is deductible in this instance? So you are renting a home, which you are then in turn renting out. Your situation is right back to those homeowners who may be paying property tax, and you have to prorate the rent that you are paying to be in that place. Part is for your personal use and part is a business expense. So you are going to have to prorate the rent that you pay based on the total square footage of the home and the space that you rent out, as well as the number of days that you are renting out the space. Lots of questions about receipts are coming in. So we want to discuss what constitutes a receipt and what needs to be on the receipt. First of all, your credit card statement. It's good for you keeping track of your expenses. It is not acceptable documentation for Revenue Canada should there be an audit or an assessment. Typically, when you look at your credit card statement, you see the date, you see the vendor, and you see the amount. There's no other details. 5 things we're looking for on that receipt. We want the name of the vendor, clearly stated, Costco, Home Depot, your local Esso. We want the date on the receipt. We want the item that you purchased and the amount paid for that item. We also want to see if there was any tax paid. So in order for it to be a valid receipt, those are the 5 things that we need. That's typical what we see if you go to the store. Remember we talked about the bookkeeper or the housekeeper coming in to do some cleaning or helping you to put your records together? You want to have a receipt that indicates their name, their social insurance number, and the amount that you paid to them for the service. Okay? So there are very specific things that Revenue Canada is looking for in order to know that that is a valid receipt. And I can't stress enough, keep your receipts for those supplies for the rental separate from your personal expenses. And we're going to wrap up with one last question. Is it still a primary residence if it's rented more than 50% of the time. So what we're looking at here is you have your home. This is your personal residence. You're living in it and you're renting it out more than 50% of the time. You are not going to lose the exemption for primary residence unless you are claiming capital cost expense on that building. Okay, so I'm going to repeat that. You're renting it out more than 50%. You're not going to lose the claim as a primary residence unless you are claiming capital cost on your expenses related to the rental income. I want to thank you for all of your questions. I think we've touched on every area throughout the webinar. We'd like to remind you to visit a local office. It costs you nothing to ask your tax professional a question, and it is important for you to have correct and accurate information. If you have any other questions, visit the retail office in your community. Go online, and this video will also be available to you. So I want to wish you happy tax filing, and thank you for joining us this evening.